Thank you very much, Alexandra, for a very kind presentation. Thank you for the opportunity to address you all today. No doubt the subject matter of this conference is very interesting, but I will start from, let's say, the angle that we policymakers, or at least those who are preparing policy documents for subsequent negotiations in Council or Parliament, what we're currently thinking about and what is maybe the essence of our key reflection. So Europe has been talking about the need to grow scale of European capital markets for a very long time. And now it has taken scale to the forefront of its actions. Why scale, and how ultimately retail investors come into play? Something that Alexandra asked as a question herself in her introductory remarks. So why they focus on scale? Because geopolitical tensions make global financial markets increasingly volatile, increasingly unpredictable, and much more difficult to access. So basically markets are becoming less and less global, definitely less global than they used to be. Over-reliance on third country depth and breadth works only as long as geopolitics is aligned with geographies of deep and liquid capital markets, and today it is not. And if you cannot tap into somebody else's deep markets, or at least not as easily as before, you'd better grow your own scale at home. Because without scale, you cannot access capital cheaply, and ultimately you cannot become competitive across many sectors of the economy. And let's face it, access to financing is something universal. It's not specific to any given sector of economy, but to all sectors of economy. Now, how can scale be built in Europe? I think there are essentially three ways. So either you start connecting better individual pools of liquidity, national pools of liquidity that are all arguably shallow on its own, but jointly can be deemed deeper. Or you grow individual pools. So basically you attract new financial resources, new investments in capital markets, or you do both. And preferably you do both, and Europe chose to do both. In the past, there were attempts to grow scale by tackling fragmentation. But as Alexandra also mentioned in her introductory remarks, a great emphasis was put on data. I think consolidating on data space. So we've put forward a proposal on the consolidated tape in equities, bonds, derivatives. There was a proposal on the European single access point for other types of data. However, although very important on their own, I'm sure we will discuss the tape soon enough, those actions were somewhat lingering on the margin of the main fragmentation issue, and to an extent avoiding confronting the root cause of the problem, which is the lack of a truly single rulebook in the EU and a lack of single supervision ensuing from ensuring uniform oversight in the EU. Similarly, attempts were rather timid on the second element, growing the investment base. Now it has never been a question of what, it was rather a question of how, because there was never a question of what we need to do, and the answer is very easy: to increase retail investor participation. So either direct or indirect. And what is important is to acknowledge that in that paradigm, institutional investors are merely enablers. They're somebody who channels, who facilitate, who perhaps play a certain role by attracting retail investment, but per se they're not the ones who are growing, they're not the ones who are inputting resources into the system, because those resources have to come from retail investors. And the latter could only be achieved if we ensure more citizen participation across all age groups and all income groups, and this is quite important. Now, CMU 2.0 ask the right questions and address the right topics. So financial literacy, pensions, better and more efficient retail investment intermediation, all featured quite prominently in the 2020 CMU Action Plan. What it lacked, perhaps, is a certain degree of political momentum that would be translated into boldness of policy making that would allow to make decisive steps in all of those areas. Financial competence framework jointly developed with the OECD, in-depth analytical work on pension auto-enrollment, retail investment strategy were all steps in the right direction, but also visibly not sufficient steps. SIU 1.0 no longer lingers on the margins of what should be done. It is bold in what it has already put on the table for member states and the Parliament. In the areas where further integration was deemed necessary, the Commission tabled the mega market integration and supervision package, MISP. The proposal that is quite remarkable both in terms of depth and breadth. And nonetheless, the proposal remains to be very targeted because it focuses on the single most important theme, or actually two themes, but which are closely interrelated: scale and ensuing competitiveness. Breadth, because for the first time ever, it adopts a transversal approach, going through the whole value chain of capital markets. Depth, because of the sheer level of ambition that the MISP proposal transpires, solely focusing on what needs to be done and what can be accepted. It starts with seeking scale for European funds, setting the foundation by removing many of cross-border friction in the area of passporting, for bigger, more cross-border European market players. It then goes up the chain to address obstacles related to trading by focusing on removing national gold plating and weaknesses in the EU rulebook that until now continue to suffer from a sizable national nexus, often by being silent, so we are silent in EU law, and hence, by removing this gold plating and by no longer being silent, we are setting a commercial rationale for cross-border consolidation. We're not forcing consolidation, we are incentivizing it, and with it, we incentivize building the scale. It then ventures into post-trade by tackling lack of interoperability and exploring the full potential of T2S for better and cheaper cross-border settlement in the EU. MISP also doesn't forget digitalization and innovation. It expands the scope of the DLT pilot that would allow for better, broader experimentation in the area of trading and post-trading solutions. Finally, it does all that by addressing the so-called elephant in the room: divergent and often inefficient cross-border supervision. Because focusing on divergent rules without focusing on divergent implementation, it's like trying to run with one shoe, where you tie your laces and the other shoe, leaving your laces undone. You might start running, but you won't get far. Within each of these areas, the MISP proposal does not shy away from going into some of the most contentious areas, such as depository passport for asset managers, no requirement to set up a local entity for trading venues, or obligation to participate in T2S, or bidirectional links between CSDs. Not to speak of supervision, where MISP, while duly, and I would like to emphasize this, duly respecting the principle of subsidiarity and proportionality, proposes to transfer supervision of certain financial entities, notably those of a large size and with an important cross-border footprint, to the EU level, entrusting ESMA with wider responsibility and powers. ESMA that is bigger, that is more independent and efficient in its decision-making. Now, how would all of those measures affect retail investors? The key question for today, who are at the very end of the chain, ultimately. Well, the answer is quite simple. By removing frictions in trading and post-trading, by cutting European and national red tape, including the one that stems from national gold plating, the cost of transactions in Europe should go down. This should directly benefit retail investors who should get reduced bills from their brokers. Markets that are liquid and ultimately more agile should also lead to lower illiquidity premium and tighter spreads, which would imply more effective pricing of orders, including those of retail clients. A better integrated market that would not be, for example, constrained by frictions in post-trade should also become more interoperable. Also means that shopping around would become easier, more accessible, and with that resulting in more competition between market participants, trading venue operators, and once again lower prices for end users and clients. Now, many of anticipated cost savings would only be passed on to end clients if there is a remaining degree of effective competition. This is very important. So whatever consolidation we have, it should result in a competitive constraint on operators. That competitive constraint should result in a competitive discipline on market operators who would be competing more aggressively, including for retail flow. And to be honest, retail flow, the larger it becomes, and we hope it will become very large one day, is likely to be, and to some extent already is, the focus of future competition between trading venues and trading operators. This may become even more relevant with greater direct retail investor participation in the market, where retail investors, for example, invest directly in exchange tradable securities away from traditional fund and insurance products. Now, the MISP is not the only measure put forward by the Commission that is supposed to benefit retail investors and contribute to their more active engagement with capital markets. In the areas where the Commission lacks competence or where we think that the impact of national measures is likely to be more meaningful, more immediate, more sizable, this time around the Commission proposed non-binding instruments, legally non-binding instruments such as Commission recommendations. While not being binding in nature, those recommendations nonetheless provide a very powerful political signal, and they should set the foundation for coordinated action between member states in a number of important areas where further progress is likely to be difficult but is desperately needed, such as financial literacy, taxation of financial gains from investment, and pensions. More concretely, last year the Commission adopted a blueprint for savings and investment accounts that included also a targeted recommendation on simplified and advantageous tax treatment of investments. There was also a recommendation on pension auto-enrollment that sought to encourage member states to consider this very effective tool for channeling retail investors' retirement savings, citizens' retirement savings, more like, in capital markets, while allowing simultaneously to address the socio-economic challenges of today, such as the inadequacy and lack of sustainability of pension systems in many member states, while at the same time contributing to the size and scale of capital markets. The Commission also put forward an ambitious strategy on financial literacy to tackle the long-standing barrier for low retail investment participation in capital markets. The latter is already being rolled out with the first inauguration meeting between the so-called financial literacy ambassadors that are supposed to play a role in promoting financial literacy. And what is very important, their role is also to steer retail investors towards what we call reliable financial literacy programs, resources, and interlocutors. Because financial literacy can also be marketing in disguise, and we don't want that. It is now for member states to build on those elements in their national legislative programs. It is also now for member states and Parliament to reach an ambitious political agreement on the MISP, as Europe may not have another chance soon enough to implement such a wide reform with far-reaching structural consequences on the EU capital market. This will ultimately determine whether or not Europe can remain competitive in the future world, which may be marked by a very different geopolitical setting and a set of very different political alliances. Last but not least, it is also only by combining all our forces together, those of the Commission, member states, Parliament, private stakeholders, that we can finally make decisive progress on market integration and greater retail investor participation. And with that, we can jointly grow the scale of EU markets to make them deeper, more efficient, and more competitive. Thank you.